There are two main ways to pay back a mortgage you've taken out on a property. These are repayment and interest-only type mortgages. But which one is the right choice for you and your circumstances? Let's grab a coffee and find out. So first off, what's a repayment mortgage? A repayment mortgage is a loan provided by a bank with interest applied. It's much like any normal loan you might take out. The main difference is the loan is specifically for property and is secured against the property. This means that if you were to default and not pay the monthly repayments, then the bank could repossess the property. The amount you pay each month is calculated so that the full amount borrowed, plus the incurred interest on that balance, is fully repaid by the end of the mortgage term. This is usually around 25 years, but it could be more or less depending on what was agreed at the outset of the loan. As the full balance is being paid, this means that you will own your property outright when you finish paying your mortgage. Most repayment mortgages include the option to make additional payments to reduce the principal amount of the loan faster. This essentially means that you can reduce the balance of the initial borrowed amount quicker. Normally, overpayments of this type are allowed up to 10% of the mortgage balance per year, with no additional penalty charges being applied. Most repayment mortgages require 85% loan to value. This means you'll need a 15% deposit. However, depending on market conditions, 90 or 95% loan to value mortgages may be offered. So this means deposits of either 10 or 5% respectively. Repayment mortgages are normally used when you're buying a home that you will be living in. You wouldn't normally use a repayment mortgage for an investment. Now, what is an interest-only mortgage and what makes it different? An interest-only mortgage is a loan provided by a bank to buy a property. But your monthly repayments only go towards the interest that you owe on the balance borrowed. This means that you will always owe the initial amount borrowed during the loan, as your monthly mortgage payments only cover the interest and do not reduce the initial balance that you borrowed. As you are not also repaying the balance borrowed from the bank, this means that your monthly payments will be lower. But remember, you will still owe the same at the end of the term as when you took out the mortgage. So you will need to repay the whole balance at the end of the mortgage to fully own the property. You could do this by using a repayment vehicle such as a savings plan, ISA, investment fund, or a pension. Perhaps you could use any kind of lump sum you receive before the mortgage ends, such as an inheritance or pension withdrawal. Alternatively, you could sell the property to pay back the lender. Most interest-only mortgages require 75% loan to value. This means you'll need a 25% deposit to purchase the property with this kind of loan. Interest-only mortgages are normally used for buy-to-let investments, and hence they are often known as buy-to-let mortgages. Normally, you should only use an interest-only mortgage if you are purchasing a buy-to-let investment. You may also find that lenders are reluctant to give you a repayment mortgage for a buy-to-let investment. So interest only is usually the only choice for investments, but that's okay because that's usually the best option for investments. Most interest-only mortgages do, however, offer the option of 10% capital repayment per year. This means that if you want to, you can make extra payments to reduce the principal amount of the loan. And as long as you stay under the 10% amount, there are normally no additional penalty charges for this. Okay, so which is best? Well, we've already discussed how you would generally use a repayment mortgage when buying your own home to live in. But if it's an investment, then you use an interest-only mortgage. With repayment mortgages, you'll pay less interest overall because what you owe decreases every month. This means that later in the mortgage term, more of each payment goes towards clearing the balance. And with repayment mortgages, if you make all the repayments, you'll own your home at the end of the mortgage. However, the monthly repayments will be higher than if you'd use an interest-only mortgage. This is one reason why interest-only mortgages are generally best for investment properties. The initial deposit required for a repayment mortgage is normally lower than what is required for an interest-only mortgage. Interest-only mortgages give you more flexibility to decide where your money goes. This is because you can decide how you want to pay the mortgage balance off at the end of the term. And you also have extra cash from one month to the next. So it's up to you if you want to make overpayments for the mortgage or perhaps make improvements to the property. Interest-only mortgages are considered to be more risky as you may be relying on other investments to produce the funds to pay down the mortgage at the end of the term. So this may mean you might have to sell the property at the end of the term even if you didn't plan to. However, it should be noted that the initial amount borrowed will likely be less in real terms due to the effects of inflation. Okay, so to round up, I'd say that for most people looking to buy their first home to live in, they should be using a repayment mortgage. But if you're considering investing in property, then a buy-to-let mortgage is likely the best option. However, the main thing to consider is what will be your plan to repay the full mortgage balance at the end of the term. The final point to make is about how much they cost. So a repayment mortgage will be cheaper overall, as you can see in this example. However, it does obviously come out with more expensive monthly repayments. If this video has helped you out, then it would be greatly appreciated if you could hit the like button and subscribe for more to come. Thanks for watching.